If you do not understand bonds, you do not understand money. I do not mean that as a clever line. I mean it literally. A great many people spend their whole lives talking about stocks, real estate, entrepreneurship, inflation, retirement, and wealth, while never really understanding the one quiet number sitting underneath all of it. That number is the risk, free rate. Free rate. You do not truly understand what money costs, what capital should earn, why some businesses become easier to build in one period and painfully difficult in another, why investors act like cowboys in one decade and cautious undertakers in the next, or why an opportunity that looked brilliant last year can become uninteresting when the bond market changes its mind. People like exciting subjects. Artificial intelligence is exciting. Politics is exciting. A spectacular stock market boom is exciting. A giant crash is exciting. Japanese central bank policy can be exciting if you are paid to sound worried on television. Bond yields are not exciting. That is exactly why they matter so much. The most important things in finance are very often the things that do not photograph well. They are the plumbing, the structure, the base rate, the terms on which capital can exist. That is what bonds are. A bond is simply a loan. You lend money in return, you receive interest, and later your principal back. When the borrower is a government with very strong perceived credit, that yield becomes the rough baseline from which every other decision starts. You may call it boring. I call it gravity. And gravity decides what can fly and what cannot. If the government will pay you 5% to lend it money with a very high degree of safety, then every other use of capital has to compete with that in some meaningful way. It does not merely have to beat it by a penny. It has to beat it in a way that justifies the extra uncertainty, the extra management burden, the extra liquidity, the extra stress, and the extra possibility that something will go wrong. That one truth explains more about the real world of business and investing than most people learn from 20 years of headlines. I have always liked businesses, not tickers, not television narratives, not market gossip, businesses. And a business is only attractive relative to the alternatives available to capital. That is the part people forget. They say a 10% return sounds good. Fine. It may be good. It may also be entirely uninteresting. If the world around you lets capital earn 5% with almost no effort, then a 10% return from a business that requires your time, your reputation, your skill, your operating discipline, your emotional resilience, and your willingness to tolerate uncertainty is not automatically a wonderful bargain. It may still be worth doing, but now the spread matters. Now the quality of the 10% matters. Now the durability of the business matters. Now the capital intensity matters. Now the downside matters. Now the fact that your life is involved matters. This is why I tell people that the bond market is not some side room for specialists. It is the starting line for every serious financial decision. It tells you what the world is paying for passivity. And once you know what the world is paying for passivity, you can begin to judge whether activity is really worth it. That is the question. Not whether an opportunity sounds profitable. Whether it is attractive compared with the next best lawful, sensible, low-effort use of money. That is how adults should think. Now, let me simplify the mechanism. When bond yields are very low, the whole world behaves differently, consumers spend more easily, businesses borrow more aggressively, investors reach for risk, valuations rise, speculative stories multiply, private markets become frothy. Companies promise growth far into the future, and the market is willing to pay astonishing prices for those distant hopes because the discount rate is small. Money feels cheap, people stop treating it with respect. When bond yields are high, the opposite begins to happen. Spending slows, risk appetite falls. Lenders become more selective. Businesses that depended on easy financing start to look much weaker. Consumers become careful. Projects that made sense when capital was free stop making sense when capital costs real money. Again, the market begins rediscovering discipline. The public likes to talk about these shifts as though they were all caused by mood. They are not. Mood changes because the mathematics changed first. This is why I say bonds are gravity. The lower the yield, the more money floats. The higher the yield, the more money gets pulled back toward discipline. You can see this in nearly every corner of economic life. Take a business selling wants rather than needs. Beauty products, luxury upgrades, fashion purchases, highly discretionary services. When rates are high and money gets tighter, those categories often feel pressure. First, not because the product suddenly became bad, because the customer's margin became thinner. The person looking at a beauty treatment, a cosmetic upgrade, an impulse purchase, or some other want is now comparing it against a world where the credit card costs more, the mortgage costs more, the car payment costs more, and even the savings account finally offers a rate high enough to make deferred spending feel rational. That changes behavior. The need did not vanish. The consumer simply started asking harder questions. Now take a more ordinary business. Suppose you operate in the heating and air conditioning world. A lot of what you sell may be financed over time. When bond yields are low and borrowing is easy, financing a major replacement project looks manageable. When bond yields rise, financing becomes more expensive, approvals become more difficult, and the same customer begins delaying the large purchase if he can. Demand shifts. Suddenly, the expensive replacement becomes harder to sell, while the small maintenance job, the $50 filter, the service call, that keeps the existing unit alive for another year, or the inexpensive improvement that prevents a larger cost later becomes easier to sell. The need is still there. The shape of demand changed because the price of money changed. That is how bonds move through the real economy. Quietly, indirectly, relentlessly. This is why I say to business owners that they are, whether they admit it or not, capital allocators first and operators. Second, the operator thinks in sales, staffing, customer service, marketing, growth, and product, all important. The allocator asks a deeper question. If capital has a base cost, and if passive money can earn a certain return, then what am I really asking this dollar to do? Am I earning enough for the risk and effort involved, or am I simply staying busy and calling that profit? That distinction matters enormously. A lot of businesses look profitable and still produce poor returns on capital. That is one of the saddest truths in commerce. A man can work 80 hours a week, have respectable revenue, pay his employees, keep vendors happy, and still own a machine that is not doing anything, especially impressive relative to the cost of capital in the world around him. He is operating. He is not compounding. Those are not the same thing. That difference decides a great many futures. Let me make it concrete. Suppose I can buy a small business. I understand the industry. I know what is wrong with it. I know where the inefficiency lives. I know how to improve the offer, tighten the process, and possibly increase margins. Wonderful after all of that. I estimate I could earn about 10% on the capital required. 10% sounds attractive in isolation. The public hears double digits and starts nodding. Fine, now compare it. If the risk-free rate is about 5%, then the spread between doing nothing and doing this business is about 5 percentage points, and that 5 percentage points must compensate me for everything else. The chance I am wrong, the time required, the opportunity cost of my attention, the stress, the possibility of recession, the chance that customers vanish, the possibility that my diagnosis was incomplete, the fact that the capital is less liquid, the possibility that the business needs more reinvestment than I expected. Once you think this way, a great many apparently attractive opportunities become much less interesting. That is not cynicism. That is clarity. The bond yield saves you from wasting your life on marginal opportunities. That is one of its greatest gifts. People think discipline is mainly about saying no to foolish things. That is true. But discipline is also about saying no to good-looking things that are not good enough. A lot of mediocre lives are built from accepting opportunities that looked respectable, but did not offer a large enough spread over easier alternatives. That happens in careers, it happens in acquisitions, it happens in real estate, it happens in investing, it happens everywhere. Now let us move from return on capital to cash generation, because here the public is even more confused. They think profit is what matters most. Profit matters, it is not what matters most. Cash generation matters more. You can report profit and still weaken yourself. That is not a contradiction. It happens all the time. Imagine a company that spends $500,000 on inventory, operations, and customer acquisition. It turns that effort into $1 million of sales. After everything, it reports $300,000 of profit. Wonderful. People hear that and think the business must be healthy. Maybe, maybe not. If it requires another $500,000 of capital just to repeat the process at the same scale, or grow modestly, and if the $300,000 of reported profit is not enough to fund the next cycle of working capital, then the business may look profitable while remaining cash hungry. That is dangerous. The owner becomes trapped in a paradox. Growth looks good in the income statement, yet every step forward creates more demand for capital. The faster the company tries to grow, the more it strains itself. A business like that can easily seduce its owner into thinking he is building wealth while actually building dependence on outside funding. That is not the same thing. Real wealth in business is not profit alone. It is high returns on capital combined with the ability to reinvest or distribute cash without starving the machine. That is why I care so much about return on invested capital. If every dollar of growth requires another dollar of capital, you have a difficult machine. Maybe it can still work. Maybe the scale becomes wonderful later. But the burden is heavy. If instead you build something where the incremental capital required is low relative to the cash that comes out, then now you have a very different animal. Now you can compound. This is what the best businesses do. They earn money in a way that does not constantly beg for more money just to stay in motion. That distinction explains a great deal about why some companies become magnificent and others stay chronically hungry. This is also why so many of the world's strongest businesses share certain features. They have some kind of moat. They can raise prices without losing too many customers. They do not need extreme amounts of new capital for every bit of growth. And the people running them know how to allocate the resulting cash intelligently. That is the whole game in one paragraph. Everything else is commentary. Let us take these one by one. First, the moat. A business without a moat is trying to outrun gravity with bare hands. If there is no brand, no customer captivity, no process advantage, no geographic dominance, no reputation moat, no distribution edge, no switching cost, then the return on capital becomes fragile. Competitors can enter, margins get attacked. Customers leave for small discounts. The business becomes a commodity, and commodity economics are cruel. A serious business must protect itself somehow. The bond market does not care whether your story is inspiring. If your business has no defenses, capital should demand a much higher return to tolerate that weakness. And if it does not, the capital is being foolish. Second, pricing power. Pricing power is one of the great wonders in business. It means the company can raise prices without losing enough customers to destroy the economics. That matters especially when inflation appears, or when the cost structure shifts. If your inputs get more expensive and you cannot pass that increase on, your margins get squeezed. If you can pass it on, the business survives the new environment much better. A firm with genuine pricing power is a very different creature from one that depends on always being the cheapest. The cheapest seller has a fragile throne. The useful seller has a stronger one. Third, low capital intensity. This may be the most underappreciated feature of wonderful businesses. If I must constantly pour huge amounts of new capital into the machine just to maintain modest growth, the compounding will be heavy and frustrating. If instead I can build something once and sell it repeatedly at low marginal cost, now the economics become very interesting. Software is the obvious example people use, and for good reason. You build the product, you maintain the system. You sell to one customer, then 10, then 1,000, and the incremental cost does not rise proportionally with the revenue. That is a beautiful structure. But it is not limited to software. Knowledge businesses can have this feature. Franchising can have this feature. Certain brands can have it. A business built on systems, trust, process, and repeatability can be capital light in ways that transform the return profile. That is one reason I admire models that convert know-how into a durable machine. If a person figures out a process, a distribution system, a service model, or a branded operating playbook, and can then sell that system repeatedly without rebuilding the whole thing from scratch. Each time he has moved into a far better part of the economic landscape. That is the kind of business that can meaningfully outrun the risk, free rate over long stretches. Fourth, capital allocation. This is where many excellent operating businesses become mediocre investments. They generate cash and then do foolish things with it. They overpay for acquisitions. They buy back stock at silly prices. They expand into adjacencies that flatter executive ego more than owner return. They dilute owners. They keep everything complicated because complication gives management somewhere to hide. A good allocator is rare. A good allocator treats every dollar as though it came from a loved one who worked hard for it. He asks where the next dollar should go, back into the business, out to owners, into acquisitions, into debt reduction, into some durable future advantage. He does not spend money because it is there. He spends because the use clears a hurdle. That is what serious adults do. Now you can see why the risk-free rate sits underneath everything. If bonds are paying a healthy rate, then mediocre decisions become more obviously mediocre. The hurdle is clearer, the opportunity cost is real. Sloppy capital allocation gets exposed, weak business models get exposed, speculative promises get exposed. When money is nearly free, a lot of nonsense can survive because capital is too easy. When money has a price, the world becomes more honest. I like honest worlds better. They are not always pleasant. They are instructive. This is why I think the average person would benefit enormously from understanding bonds before trying to sound sophisticated about entrepreneurship or investing. If you do not know what the base rate is, you have no idea what a good return actually looks like. You are just reacting to whatever number sounds attractive in isolation. 10%, 15%, $1 million of revenue, $300,000 of profit. Wonderful. Compared with what, on what capital, at what risk, with what effort, with what moat, with what pricing power, with what reinvestment burden. Those are adult questions. The world is full of childish business talk, big revenues, fast growth, exciting categories, massive total addressable markets. None of that matters if the economics are weak relative to the alternative uses of money. This is one reason I have always liked dull businesses much more than the public does. A dull business with strong economics is worth infinitely more than an exciting business with weak economics. Excitement cannot rescue poor returns on capital forever. Now let me speak directly to the small business owner, because he is often standing in the most emotionally dangerous part of this discussion. He built something. He fought for it. He sacrificed for it. He identifies with it. That makes objective thinking harder, not easier. If he is not careful, he starts treating his own business with the same sentiment that a parent treats a child. He wants it to be special. He wants growth to prove something. He wants persistence itself to count as return. The market does not grade that way. The market grades by outcomes. If your business cannot consistently produce returns meaningfully above the risk-free rate after accounting for the capital, effort, and risk required, then you do not have a wonderful business. You may have a respectable job wrapped in a corporate shell. Those are not the same thing. There is no shame in that distinction unless you insist on lying to yourself about it. A mediocre business can still feed a family. A mediocre business can still be sold. A mediocre business can still be a stepping stone to something stronger. What it should not be is worshipped. Worship makes people stay too long, and staying too long in the wrong machine can cost more than one failed investment. It can cost a life. Time matters, your attention matters, your energy matters. If a business produces only a thin spread over the risk-free rate and demands enormous emotional labor in the process, you should at least have the honesty to say what you are doing. You are not compounding at a wonderful rate. You are buying yourself employment with additional headaches that may still be acceptable. It is not the same thing as a great capital allocator building a rich enterprise. I think clarity is one of the kindest things a person can offer himself. Now, let me return to the ordinary person who is not buying small companies and not issuing millions in purchase orders, but simply trying to understand money well enough to avoid being poor forever. For that person, the bond market still matters profoundly. It tells him when the world is rewarding patience. It tells him when risk should be priced more aggressively. It tells him why certain sectors are under pressure. It tells him why customers may be buying less. It tells him why financing offers convert differently. It tells him why housing feels strained. It tells him why investors suddenly care more about earnings than stories. It tells him why capital is easy in one era and rationed in another. Once you understand that, you stop being confused by every headline. You may still not predict perfectly. Prediction is overrated, but you stop being surprised in the wrong way, and surprise is expensive. That is the whole point. I do not need everyone to become a bond trader. I need them to stop pretending bonds are irrelevant. If you do not understand what the risk-free rate is doing, you are trying to interpret the whole financial world without understanding its measuring stick. That is like trying to discuss gravity while insisting you are somehow above physics. You are not above physics, and you are not above the bond market either. It sits underneath your job, your mortgage, your business, your customer, your competitor, your portfolio, and your future. The people who understand that gain a tremendous advantage, not because they suddenly become brilliant, but because they stop making category errors. They stop calling weak deals good. They stop confusing revenue with return. They stop admiring profit without cash. They stop funding businesses that cannot earn the alternatives. They stop chasing hype when the hurdle rate has risen. They stop wondering why everything feels tighter and start seeing the mechanism that is valuable, very valuable. So if you ask me where wealth really begins, I will not begin with hustle. I will begin with understanding the price of money. Then I will ask whether what you are building can truly beat it. If it cannot, then you need to change the business, change the structure, change the allocation, or change your expectations. The world does not owe you a premium simply because you are trying hard. Capital gets paid according to what it can earn elsewhere. That is the game. And once you understand the game, you stop making emotional decisions and start making economic ones. That is a much better way to live. It is quieter, it is less dramatic, and it produces much better results over time. If you do not understand bonds, you do not understand money. I mean that exactly as much at the end, because bonds are not just one asset class among many. They are the baseline, the hurdle, the cost of waiting, the reward for passivity, the gravitational field underneath all capital allocation. Understand that, and 1,000 things begin making sense. Ignore it, and you may work very hard for a very long time while never fully understanding why the world keeps paying you less than you